3M offers investors a robust 5.86% dividend yield. But is the stock too risky for dividend stock investors? I'm going to talk about that in this brief video here. Of course, when you're investing in dividend stocks, it's important to not just look at the dividend yield, to look at more than that, right? Because if you earn a 5.86% dividend yield, but the stock price declines by more than that, then you've actually lost money on your investment for the year. Because when you invest in the dividend stock, you're exposed to the changing stock price as well as the dividend yield. So it's important to look beyond the dividend yield and look at what's going on at the company, and if those factors could implicate that the stock is too risky to not take that robust dividend yield, to instead look elsewhere. So 3M has a couple of interesting things going on. Something that I'm sure most of you, if you're looking at 3M stock, you're probably aware of the litigation ongoing with the combat arms. 3M continues to support Aero Technologies through mediation discussions. The 3M has already set aside more than $1 billion to mitigate the costs from a legal issue stemming from defective earplugs it sold. Army and veterans are addressing a big lawsuit. It could cost the company more than just the $1 billion that it set aside. However, the company said that they are focusing on achieving a resolution that's efficient and equitable for all parties. So we continue to address litigation by defending ourselves in court or negotiating resolutions as appropriate. Now, the outcome of this case is highly uncertain, and I don't want to speculate on that, but I will say, I'll say it again, the company has already set aside $1 billion. They're also trying to spin off this segment in bankruptcy to help protect 3M's core business. That may or may not be effective. So the company has several strategies and several risk mitigation techniques it is undertaking to potentially offset the risks from this litigation hurting the company meaningfully. But that's not the only risk 3M is facing. The CEO said the CFO said that we experienced significant end market weakness in consumer electronics, shifting consumer spending patterns, along with the retailer destocking and mixed industrial end markets. All of these factors are hurting demand for 3M's products, which strongly rely on consumer purchasing behavior. But now that consumers are spending more of their money on services rather than goods, right? During the pandemic, people were buying goods like electronics, furniture, phones, office supplies, building out their home office, buying TVs, things that they were consuming at home. Now people are spending their money on travel, theme parks, concerts, bars, restaurants, areas where 3M is less beneficial from, like benefiting less from those areas. So those factors led to 3M's first quarter sales to fall by 9.7% year over year, a significant decrease for the industrial giant 3M. However, is all of that bad news already incorporated in the stock? Because if you look at the stock price, it's down significantly off its high. And what I have here pulled up is 3M's price to earnings ratio going back 10 years. And right now, 3M is trading at a price to earnings ratio of 10.61. And in fact, it's been trading at this range for a little over 6 months now, close to a year maybe. And if you look back at the last 10 years, that's the cheapest this stock has been by a considerable margin. In fact, before 2022, the stock had not traded at a price to earnings below 16 in the entire decade. Briefly, it touched 16 right at the onset of the pandemic. But before that point, it comfortably traded above 16. It traded at a peak of about 32 Right now, you're able to get 3M stock at 1/3 its peak valuation. And of course, there's a reason for that, and it's because the issues the company is facing. But I would argue those issues are largely reflected in the cheaper stock price. So, to answer the question I posed in the headline, I don't think 3M is too risky for dividend stock investors because I think all of the risks, or many of the risks that the company is facing, is already reflected in the stock price. So yes, you're getting a company with significant risks at the moment, including the litigation and the slowing consumer demand. But at the same time, you're also getting a stock that's trading at a significantly cheaper valuation than it has in the last decade. In fact, the cheapest that it's been in the last decade. So you're getting a bit of an offset to the risks. So to answer the question, no, it's not too risky for dividend stock investors, and it is actually a reasonably good stock to buy right now if you're looking for a good dividend stock. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.